Have you ever heard people speak about bonds and you just can't seem to keep up with the conversation? Have you ever tried researching the topic but everything seems just a bit too much? Believe me, I have, and in this video I'll be sharing the basics of bonds in an easy to understand way, how they work and why you should consider investing in them. After watching this video, you'll be confident enough to start talking about bonds and to start investing in them as well. Before we jump into all the nitty-gritty stuff, there is three very important things that we will be discussing, and these are the things that you need to focus on to understand the information that I will be sharing in this video. First, we'll talk about the coupon rate, then we'll talk about the maturity rate, and then lastly, the credit rating. Before I explain in detail how the government bond works, I want to show you guys this quick illustration that might help you understand the process a bit better. So, with that said, we have three parts to this equation. First, we have the government or the corporation which will issue the bond. Let's call it the dealer. Secondly, we will have our capital investment amount, or we can call it our lump sum investment. And then we have the interest that we will receive. So what happens is the government or corporation will issue a bond, and we as the investor will invest a certain amount or a certain lump sum to buy these bonds. What the government will then do is they will pay us an interest amount until we reach the maturity date. Once the maturity date is reached, we will receive our initial capital investment again. And this will happen with a lot of investors. Before we go ahead, I would really like if you guys would subscribe to my channel, share this video with your friends and family, and really just try to support me by commenting and letting me know what you think about the content that I am making. If you like this video or you subscribed, here's a photo of a cute puppy. So let's start at the beginning first. So what is a government bond? How do they work and what makes their price move? A bond is a type of debt-based investment where you loan money to a government in return for an agreed rate of interest. Governments or corporations use them to raise funds that can be spent on new projects or infrastructure, and investors can use them to get a set return paid at regular intervals. When you buy a government bond, you lend the government an agreed amount of money for an agreed period of time. In return, the government will pay you back a set level of interest at regular periods, known as the coupon rate. This makes bonds a fixed income asset. So to put it simply, your coupon rate will be the return that you receive, or let's call it interest. Once the bond expires, you'll get back to your original investment. The day on which you get your original investment back is called the maturity date. Let's call it the end of the investment. Different bonds will come with different maturity dates. You could buy a bond that matures in less than a year, or one that matures in 30 years or more. So let's say, for instance, that you invested $10,000 into a 10-year government bond with a 5% annual coupon rate. Each year, the government would pay you 5% of your $10,000 as interest, and at the maturity date, they will give you back your original $10,000. The terminology surrounding bonds can make things appear much more complicated than they actually are, and that's because each country that issues bonds uses different terms for them. In the United States, bonds are referred to as treasuries. Treasuries come in three broad categories according to their maturity. Treasury bills or T-bills expire in less than 1 year. Treasury notes or T-notes expire in 1 to 10 years, and then treasury bonds expire in more than 10 years. Other countries will use different names for the bonds. So if you want to trade bonds from governments outside of the United States, it's a good idea to research each market individually. For example, in South Africa, it is called a retail savings bond. There are four main categories of bonds sold in the markets. However, you may also find foreign bonds issued by firms and governments on some platforms. Number one is corporate bonds, and they are issued by companies. Companies issue bonds to raise funds for large-scale projects rather than getting bank loans for them, because in many cases the bond market offers more favorable terms and lower interest rates. Number two is government bonds, and government bonds are issued by government entities and list them on the JSE debt board to raise funds for large-scale projects such as roads, hospitals and power stations. The types of bonds issued can vary. Example, vanilla bonds, variable bonds, CPI bonds and zero coupon bonds. But we have repo bonds as well. The full name for a repo bond is a repurchase agreement, and it can also be known as a sale and repurchase agreement, or a RP. This type of bond involves the sale of securities with the agreement that the original seller will eventually buy the securities back from the original buyer, usually at a higher price than what they were originally sold for. Then number four is green bonds. Green bonds allow investors access to the investment potential of green technologies, services and infrastructure. Green bonds are used to raise funds for new or existing green projects that have a positive climate or environmental benefit. So just like shares, government bonds can be held as an investment, or it can be sold to other traders on the open market. Using our above example, say that your 10-year bond is halfway to maturity and that you've spotted a better investment elsewhere. You want to sell your bond to another investor, but because better investment opportunities have arisen, your 5% coupon rate now looks a lot less attractive. And to make up on the shortfall, you might sell your bond for less than the $10,000 you originally invested. An investor buying the bond would still get the same coupon rate, like 5%, on the $10,000, but the yield will be higher because they paid less to get the same return. A bond with a price that is equal to its face value is said to be trading at par. If its price drops below, it's said to be trading at a discount, and if its price rises above par, it is trading at a premium. So which factors affect the price of government bonds? Firstly, supply and demand. Just like any financial asset, government bond prices are dictated by supply and demand. The supply of government bonds is set by each government, who will issue new bonds as and when they are needed. Demand for bonds is dependent on whether the bond looks like an attractive investment or not. Interest rates can have a major impact on the demand for bonds. If interest rates are lower than the coupon rate on a bond, demand for the bond will rise as it represents a better investment. But if interest rates rise above the coupon rate of the bond, demand will obviously drop. How close the bond is to maturity also affects it, and newly issued government bonds will always be priced with current interest rates in mind, meaning that they'll usually trade at or in the near par value. And by the time a bond has reached maturity, it's just a payout of the original loan, meaning that a bond will move back towards its par value as it nears this point. The number of interest rate payments remaining before a bond matures will also have an impact on its price. Government bonds are usually viewed as a low-risk investment because the likelihood of a government defaulting on its loan payments tends to be quite low. But defaults can still happen, and a riskier bond will usually trade at a lower price than a bond with lower risk and a similar interest rate. The main way of assessing the risk of a government defaulting is through its credit rating from the three main credit rating agencies, which is Standard & Poor's, Moody's and Fitch. It can be graded anything from a AAA rating to C ratings. Obviously, the closer to A, the better, and the less risky the bond issuer is to default. I would encourage you to go and have a look at the different ratings and the risk involved, so you understand the explanation a bit better. You might hear investors say that a government bond is risk-free investment, since a government can always print more money to meet its debts. The theory goes you'll always get your money back when the bond matures. In reality, the picture is more complicated. Firstly, as we've seen with Greece's debt crisis, governments aren't always able to produce more capital. And even when they can, it doesn't necessarily prevent them from defaulting on their payment. But aside from credit risk, there are a few other potential pitfalls to watch out for with government bonds, including a risk from interest rates, inflation, and currencies. What is interest rate risk? Interest rate risk is the potential that rising interest rates will cause the value of your bond to fall. This is because of the effect that high rates have on the opportunity cost of holding a bond, where you could get a better return elsewhere. So what is inflation risk? Inflation risk is the potential that rising inflation will cause the value of your bond to fall. If the rate of inflation rises over the coupon rate of your bond, then your investment will lose your money in real terms. Index-linked bonds can help mitigate this risk. So what is currency risk? Currency risk only applies if you buy a government bond that pays out in a different currency to your reference currency. If you do this, then fluctuating exchange rates may see the value of your investment drop, like investing in USD bills from South Africa. So how do we get started with government bonds? When a government wants to issue bonds, it will usually do so via a bond auction, where the bond will be bought by large banks or financial institutions. Those institutions will then sell the bonds, often to pension funds, other banks and individual investors like us. Sometimes governments sell bonds directly to individual investors as well. Alternatively, CFD trading enables you to trade on fluctuating bond prices using leverage without having to buy or sell the bonds themselves. Government bond ETFs are funds that can track the prices of fixed income securities, and they offer many of the benefits of buying government bonds, but with the additional liquidity and transparency. So to ask the very important question, where can you actually get started with bonds? You can go directly to the www.gov.za website to buy retail bonds in South Africa, or you can buy a bond ETF on a platform like Easy Equities. You can even invest in a bond fund with a company like Allan Gray or Coronation, for example, and it all depends on what you prefer. I personally try to invest in bonds where the fees are very low or even non-existent, because large funds like Allan Gray always charges a commission or fund fee for your investment. So I know I've shared quite a lot of information in this video, and it is sometimes difficult to understand every little detail that I explain, but even if you only learned one thing from this video, that will really make me happy. The idea of my channel is to share knowledge with you guys and to explain stuff that is really difficult in a simple way. So if I've done that, please let me know down in the comments if this video actually helped you in some way. With that said, guys, I hope to see you in my next video, and I hope that you guys have a great day.